When people hear the term central bank, they often think of a single idea: control. Control over money, control over inflation, control over the economy. But that intuition, I think, is a little bit misleading um, because a central bank is not a controller of the economy. Okay. It is a stabilizing institution embedded inside the monetary system, which gets overlooked a lot, especially in today's world. To understand what a central bank really is, we need to focus on function, not power. Okay, so let's start off by asking what a central bank is not. Okay, a central bank is not a commercial bank. Okay, it does not take household deposits. It does not make loans to the public. It does not decide who gets credit as well. And it does not directly control most economic outcomes. A central bank does not set prices in the economy. It doesn't allocate capital, decide wages, or manage private risk. Those things happen elsewhere in the system. So if a central bank isn't running the economy, what is it doing? Here is the core role, I think, of a central bank. At its core, a central bank exists to support settlement at the highest level of our monetary system, any monetary system. Okay, it sits at the top of really all forms of settlement, and not as a planner either, but as a backstop. Banks settle obligations with each other. Okay, markets rely on banks to make payments. Governments rely on markets to function. And the central bank exists to ensure that settlement can still occur when private mechanisms are under stress. And I think that's the key role. Not control, but maybe a better word would be continuity. We need to look at the central bank as a balance sheet institution, I think, especially in today's terms. A central bank operates almost entirely through its balance sheet. It doesn't issue commands. It tries to change conditions by expanding or contracting its own assets and its own liabilities. When stress appears in the system, the question is not who is confident. I think the better question is who can still settle obligations in a timely manner. When private balance sheets reach their limits, the central bank steps in to prevent settlement from breaking down, and but not to eliminate risk. Okay, so it's important to maybe keep this in mind, but to prevent the system from seizing up. Okay, really. Okay, why do central banks intervene during crises? During financial stress, institutions don't fail first. Okay, settlement does. Payments slow, funding dries up, and markets stop functioning the way they're supposed to. Central bank intervention is not about rescuing markets. It is about preserving the ability to settle obligations across the system. And this is why central banks intervene, even when it looks or seems controversial. They are not responding to prices. They are responding to the structure, the plumbing of the system. So what do central banks actually control? A central bank does not control the economy directly. What it influences are settlement conditions, short-term funding availability, system-wide liquidity at the top of the system. From there, effects ripple outward. Okay, but the central bank does not decide who gets to borrow or who borrows, who lends, or which businesses succeed. Those outcomes emerge from millions of really private balance sheets. And this distinction really matters because if you think central banks run the economy, I think every intervention starts to look kind of suspicious. If you just frame your understanding a little bit as them being settlement stabilizers, their actions will make sense to you. Central banks are not designed to optimize outcomes. They are designed to prevent collapse. And I think that's a very different mandate. But let's address some common misunderstandings why we're here. Central banks are often blamed for inflation, bubbles, and even inequality. I've heard those for sure, but those outcomes are not directly controlled by central banks. They emerge from credit expansion, fiscal decisions, market structure, and another really important one, I think, is global conditions. Central banks react to the system. They don't design it. So going back to the question, what is a central bank? Well, really, what is it? In my best definition is this. A central bank is a system-level institution that supports settlement when private balance sheets reach their limits. It does not run the economy. It keeps the monetary system functioning when stress threatens to break it. In the next Prime Ledger episode, I think we're going to look at kind of a related question. And that is, what is the Federal Reserve specifically? How it fits into this structure, what makes it unique, and I think what it does differently from other central banks. And if you want to understand why central banks operate this way at all, we're building that logic step by step in the main ledger series. This is the Prime Ledger, and these are questions, again, that are evergreen, that I think will always, right now anyways, I don't see them, I see these questions a lot, and I think it's important to start with the basics so we can kind of try to, together, understand a little bit more about what's going on. So this is the Prime Ledger series. We make these a little bit shorter, but try to get to the bulk of the answer to the question. And the main series are a lot more in depth, and they will become a lot more in depth as well, and more stats, more data, and things of that nature. So I want to thank you for listening to Prime Ledger number 2 and asking the question today, what is a central bank? So once again, I'm Justin, and thank you for being here.